Hello and welcome back to the ROI Club. Got a very special guest for the ROI podcast today. Our good friend Trader Ferg is back. He's been dealing with the apocalypse, cyclones, end of the world, offshore sell-offs, and the lot. Today we're going to have a deep dive into some of his favorite sectors, and it is going to be an absolute goldmine of information. Guys, due diligence, that's your job. Nothing we say is advice. And without further ado, Ferg, great to have you back, mate. How are things with you?
Good, man. Good. Yeah, no, good to be back on. Yeah, I've just been to Australia, managed to time a cyclone perfectly. Spent 4 days with my parents with no power and no water. We survived on whiskey and red wine and sardines, so that was good fun. But lots of quality time on the couch because we couldn't take the lift. They live on the 12th floor. There wasn't many flight attempts to go up and down the fire escape, and you couldn't go outside anyway. So yeah, that was quality time, but it was actually quite nice because I didn't have to look at the market for a while. Because recently it's just been opening the stock tickers just to torture yourself if you're heavy, pretty much anything energy related. Recently, it feels like whether it's offshore, whether it's uranium, whether it's coal, none of it seems to be catching a break. But that said, there's definitely some green shoots in some of the more niche little metals, and that's where I'm trying to keep myself occupied as well. And got some pretty heavy positions in some of them. So hopefully that asymmetry is going to offset a bit of the damage on the other side.
Yeah, it has been a little bit rough, but I mean, if you've been involved in energy for a while, you're no stranger to volatility, right? So how do you go dealing with volatility? What's your process? I know you're a fan of the book, The Art of Execution by Lee Freeman Shaw. When you hit those sorts of targets where a position's down, let's just say 20% or 25%, what goes through your mind then in terms of going back, questioning the thesis and the age-old question between do I cut the position or do I add more?
Yeah, well, it's really saying like I love that book, The Art of Execution, because he just outlines perfectly like the characteristics of like someone that will be successful in the market. And Lee Freeman Shaw was a fund manager of funds. And so he just saw literally hundreds of investors, fund managers, traders over his career. And he just pretty much segmented who were the really successful ones. And the ones that were really successful, he called them connoisseurs. And they could usually spot a trend and just ride the trend, almost being, I think he called it almost like intentionally lazy or sloth-like. Like you just, once they're on something, they would just ride it. If it went against them for a while, they would happily add to it and they would trim it very gradually. Whereas the other side of that, the people we called rabbits were the ones that when things went against them, they'd just stick their head in the sand and they'd be unprepared to add to a position and they'd just write it down. And that's always stuck with me because it's like, you should always ask yourself the question, when you're going for a drawdown, you should be almost happy to see it because you want to add more to the value. If you liked it at $20, you should love it at $10. Like that should just be unless the thesis has changed, unless some new information has come to light, that would mean perhaps that company's going to run into financial trouble. It doesn't have the runway you thought it did. Is their management doing something dumb? Are they going to throw some money on a dumb M&A? And so, yeah, that's just whenever you're going through the drawdown, it's just, yeah, it's easy to say it as well. Part of the problem is having capital because we just talked before about, I loved offshore and I'd exited. I really lightened up some of my uranium positions late last year and had quite a decent amount of cash and thought sort of end of December, I thought offshore was an absolute bargain and really leaned into a lot of that. And then it's honestly sucked, but seen that it's got even cheaper since then. I thought those prices look ridiculous to me. And what's really been holding me back more recently is one, just not having the capital, and two, understanding as well that my correlation in the portfolio between some stuff almost went to one. So what I've been now searching for is like good risk rewards that aren't as correlated. Like as you mentioned before, I really like Chinese tech because it just goes to a completely different beat to everything else in the portfolio. There's at some point, I'm really not adding anything to the portfolio. If I add another, say I fall in love with a Canadian oil producer, or it's just going to be a tight correlation with what I've already got. I'm just going to create even more volatility and pain. So I'm just as strong in the thesis, but I just know I have to accept the volatility and almost to keep myself occupied, and also understand I don't know the timing on any of this stuff. So it's nice to have stuff that, like, I love the fact I've got Chinese offshore, Chinese tech is a decent position now. Got Rhodium, which is a decent position that's just physical Rhodium that goes to its own beat. It's like completely unconcerned with what my energy portfolio is doing. Got shipbuilders, and some of them were just, after one of them went bankrupt twice. And so the amount of people that are in that to start with, such a tight little float, mostly insiders or people that have really done the work, because you're not going to have much retail participation in something that's blown people up twice, and they're hopeless. Like, even just to get any information, you're not exactly having analysts covering it, giving you breakdowns of it every day. And the recent one is tin. So yeah, I'm just writing a piece on tin at the moment, because that's been fascinating what we're seeing at the moment. So yeah, it's a mix of everything. But yeah, one that I've got more respect for is really having proper diversification in the portfolio, and not just keep hammering the energy trade. And then the fact as well is, if you have some stuff that's really uncorrelated, increase your probability that you can rotate between sectors with good timing. Like, it would be just an absolute dream if something ran while something else gets absolutely punished, and you can rebalance at a point, which is is nice as well.
Yeah, so you mentioned some great themes. Let's unpack the thesis. We're familiar with the offshore thesis, and has anything changed as far as day rates look to be flattening? But from what I can tell, it's not as if they've actually plummeted. And again, from what I can tell, it's not like there's a whole new group of new builds on the horizon. Or am I missing something there?
No, you're not. Granted, we're probably just going to stroke each other's population bias at the moment. I start with, if anything, supply is continuing to tighten. So I was never in the camp that we'd see this sort of, some of the stuff scrapped that we've seen, like scrapped at the moment. Yeah, kind of, if anything feeds into the thesis, it's just disappointing that it's all been pushed out a few years. As for just looking at insiders, which is good, and it would have served me better if I'd kept a closer eye on the likes of Tidewater when those insiders headed for the exits. If I'd lightened up then, would have helped the performance. But yeah, they're stepping up to buyers. CEO recently stepped up, and he's quoting in their recent commentary. I think with Tidewater is like 81% of their backlog is now covered. Like, if you just look forward on their valuation, I think Polaris is even higher. It's like 85, 86%, probably even higher since I last looked at it, because it pulled back to where we are today, 36. And if you look historically at how solid order books have been, they generally only sort of oscillate sort of like 3-4%. Granted, you can have, if you have a big surprise, like I think COVID, both of them took like 12-15%. But it's fascinating that it's just got that cheap, and it's and that shorted as well. And it just seems to me, I think Cuppy explained it a while back, that there's a lot of pods running around making great returns by just shorting companies based on sort of earning revisions out the next quarter, so that they couldn't care less where the company's going to trade in a year. They don't care how much it'll print cash, because they'll be long gone. They're just seen as, is it going to print negative for the next quarter or two, and they do it across a basket and make great returns. So yeah, it's painful. People obviously, some people take it as just a sin. They're just massively bearish on the sector. It's not nice to have a lot of short there, because you're constantly questioning if you're missing something really obvious. But at the same time, if things turn, they're just fuel on the fire as well. They've got to cover. Yeah, I just think it's a big opportunity, particularly if you can just look, like it's what Brad always says to me, my mentor, whenever I try and get too smart on the next quarter or two, or even the next year. He's just like, that's interesting, but everyone's playing for that. usually get any edge in that. It's just too hard. But where will this be in 3-5 years? And I think the absolute writing's on the wall that these are going to be, these assets are going to be in massive demand in that time frame, and they'll be very hard to build. There is no room in shipyards, and as a result, I think we're going to have a period of just extraordinary earnings. And they've already shown the likes of Laris, Seadrill, if it's probably merged with someone by then, but they've shown a willingness to buy back stock. It's pretty exciting. I'd love to see them really lean into the buyback programs before they even consider a new build. It's going to be a real sort of timer, like stopwatch when the day rates incentivize the first new build and see what time frames, it is a bear case, because I just went through some of my shipyard holdings, because I've got this whole thesis, you want to be long whatever the Chinese want or where the Chinese money is going to flow. And the one area in my portfolio that's questionable is I own a few shipbuilders, and I could very well be like positioning myself to get like EV'd. Like they just attack that industry, and before you know, you don't want to be messing with the Chinese in a capex heavy industry. So yeah, keeping a close eye on that. But as for now, I don't really see that as an issue. And yeah, probably rambled a bit much now, but
especially with regards to drillers. I mean, I can understand, I guess, OSVs, maybe they've got a shorter turnaround period, assuming you can get an available shipyard. But eighth generation drill ships are not something you can turn out overnight if you've got the know-how and the capacity to build it. And so until we start to see, $1.2 billion being shelled out to get some more of these on the water, I think the difference between now and COVID, balance sheets look pretty clean. How long can these companies just kind of sit at these day rates for? They're not in any bankruptcy pressure.
I think it's just a waiting game, honestly, here. I think these are the biggest layup, really, if you've got patience. No one's got patience these days. So, yeah. And you've also got to have done the work that there's not going to be a massive oil glut, and Shale's not going to do the next ramp. I kind of see it across the board. I was just because I've been asked a few times recently about like Myanmar coming back on with a tin, and then you've got like the we're in this period where whenever there was like a real supply crunch coming, there's been some miracle that kind of saved it. Like you had obviously like conventional oil rollover, and then shale just came out of nowhere, and there's 2 Saudis of energy equivalent found. You had uranium, where Kazatomprom just massively ramped the last like decade with super low cost, super quick to bring on, like ISR. You've had even not so much with PGMs, but you've had like the sort of Nor Nickel. There was supposed to be a large expansion project on that's all zero cost, because it's kind of it's a byproduct of their main production. So it was always just like, oh, it'll be fine. Like, you don't need to worry because about those sort of roll offs in supply, because there'll be another savior, kind of oil. You often see it mentioned with Argentina. It'll just be a massive ramp. The thing is, it needs capital, and people forget how cheap capital was, how abundant it was, and just PTSD from people that lit money on fire during the last shale boom. They're not just going to be waiting in line to go to have another go down in Argentina, especially when they're still trying to get rid of the last of capital controls and make sure that Millet gets everything across the line. Like he's doing amazing things, but he's still got a way to go.
They did. If you're questioning the shale boom in Texas in terms of capital incineration, you're not ready for Vaca Muerta and some of the things in Argentina. I mean, just take a look at the EPF case. They're still owed, I think, $16 billion that the Argentine government has to pay. So we're a little way off then. But I think it can get one of your pieces you were looking at, maybe an 8 million barrel a day capacity for Vaca Muerta. You think that's possible in, say, a decade, 2 decades time?
I don't think it was that high. I think the guy was saying if you could get the equivalent rigs on it. So this was Bill, forget his name. He's like it's like a real old school petroleum engineer, and been right through all the shales and seen all of them. And he was down there working for one of the Argentine producers, and he was saying if you could get 200 rigs on it, like peak, peak like US shale boom, all the wells are super productive. So you could easily do, I think it was 4 or 5 million barrels with that. But at the moment, when they asked him at the end of the interview, they're like, "What's actually probably possible?" And he said, "Within 10 years, like 1 to 2 million barrels, depending how they can scale rigs." Like the key way to track it is just to look at the rigs in Argentina. If they can add 5 a year, then they're on track to do 1 million barrels per day by 2030. The thing to remember this is that they're doing it out of like the it's mostly the two largest Argentine producers, and whereas with shale they were throwing around debt, and there was a point there where it was like over 200% of extra 100% was 200% was being reinvested in growing production. So yeah, all that cash flow, and then obviously the rest was debt or equity that they were using, and did that for years with it was like, yeah, with cheap capital, I should mention, and with the whole sort of drill baby drill incentives as well. People have kind of, obviously, as we were just talking about, have PTSD from that, so they're not going to be launching into that. Then lastly, it was interesting to see even the likes of Exxon, they also did the maths and said, yeah, we'll just sell it, a block to one of the national guys, and we're going back to Guyana, where done the maths, and it's not interesting enough. Obviously didn't stack up. So that was interesting seeing them sell off the block. And that was recently, because that was when Malay was making good progress as well. So you would have thought they would at least to try and keep some exposure there. Wasn't the case.
I think some of those decisions were made prior to the election, and I think it's a 1 or 2 year process to actually up and leave. I'm not sure about that specific case.
Yeah, that makes sense. Yeah.
Yeah, I was just reading in La Nación, because it's a very kind of left-wing propagandist newspaper, that they were using it as an example of how badly Malay was doing, that these people were leaving, but they'd made the decision like 2 or 3 years beforehand was the
that makes sense. Yeah.
reality of the situation. Someone who thinks that oil is still valuable, Fergus, apparently is nearly called him Ken Griffin, the Citadel guy. Citadel's buying some oil in the shale patch. What do you make of that, mate? I mean, they obviously think oil's going nowhere.
Yeah. I just think anyone that's like I read HFI research, and he just had a piece today. He was just like, no one cares. Like he said, I can point to everything moving in the right. Like IEA is completely just muffing it, as they always do. I love when you search like IEA, who's the best research house for like oil, and that's like IEA is the gold standard for oil forecasts. They literally never get anything right. They're like a broken clock. Like I think last year they got the correct forecast, and it was because they're always bearish, and it's like having a broken clock, and you point at it that one time of the day and like spot on. Whereas like Go Rosen been great with them. They just point to the fact that they've got this quirk where they literally just miss developing market growth every year. They put it down to missing barrels. It's sort of like almost like a footnote, and then they slowly try and revise it, and every now and then they're just so far behind they just have to revise like a whole lot of years, and it literally adds up to more or less like 1 million barrels. I think, yeah, the Go Rosen joke was, I think they're like the 12th largest oil consuming country if you added up their misses over the last decade, I think it was. So yeah, the fact everyone takes them so seriously, like there's, with Trump coming in, they're actually pushing them just to reinstate this, the current trajectory of current policies. Because if anyone that's been reading their work, you notice that literally taken away just the trajectory we're currently on with current investment, current policies. And it's all just these stated policy scenarios that are just fairy tales. None of them exist. They just miss it by more and more each year. Like I've got a few charts where it's just like, it just looks like a step ladder. Like they miss it that year. Like, no, coal will roll over next year. And then it starts at the next step up, all-time new high. This is the final year. And then it steps up again the following year.
It's like the annual event, the upward revision that happens every year. You set your clock to it. Yeah. Are you in the camp the shale patch is likely to roll over in terms of its new growth, and that's what's going to drive some of the capital back towards offshore projects, given that they're now such a low break even per barrel scenario?
So I think they're already done. So it's already, if you take out the revisions, growth's already stalled out since late 2022. And if you look through, you can work this out as well by looking through the kind of proven reserves of every asset within that produces within the sort of the US basins. But the most interesting one was Pioneer. You could kind of see, whereas Exxon was talking about gain, you could see that their crude was rolling over quite heavily, and yet their NGLs and their natural gas was up. So I think it was something like the crude was rolling over maybe 5%, and the gas and the NGLs were up about the same. And so that's generally what happens when you're you sort of, the basin's maturing, it's getting far gassier. And the Pioneer CEO, he came on and said, like, he's like, yeah, we've worked through the tier one. No one seems to want to talk about it, which it's really logical when if you go back in history, like in the start of the 1980s, the same thing happened, whereas everyone pats himself on the back for productivity, but the rig count's dropping. And it's just logical when you think about it, that if you're cutting rigs, you're going to be cutting the least productive rigs one after the other, and so your productivity is going to rise because you're keeping the good stuff running. And so the real test is when the rig count starts rising. What are you working with then? And this is what they found in the 80s, was the rig count climbed, and it was just all tier two, and it was just hard going, and it was productivity just fell off a cliff. And I think we're at that stage again, and it's what you can see if you see the reports from like Chevron. They've realized this, and they're like dialing back capex, and they're just going to try and sort of maintain, because they know if they really throw more money at it, they're just going to shorten the asset's life and work through it quicker. And people will probably start clicking onto that by the end of this year when it becomes really clear. The IEA's massive glut won't appear, and we'll end up nothing crazy, but probably like a slight deficit by the end of the year. And so and that's the fact that all the Permian growth won't show up. That'll be the biggest shortfall, and largely demand will just keep surprising. People forget, like, it's been quite low growth across the developing world.
One thing that's not entirely clear to me is if the tier one acreage obviously is coming to an end, but what's the likelihood in your mind in terms of the majors? I think will increase some of their capex in order to maintain production, and that certainly seems to be what Go Rosen were talking about in that quarterly commentary you mentioned. If that's the case, are they going to spend money offshore, or are they actually going to spend more money onshore? The oil services and some of the landowners there might benefit. As I'm aware, been one for the onshore service guys. Is there a particular reason for that?
I just see far larger moat around offshore, and the break-evens have kept coming down. If you look where the big reserves are, it just makes sense that once we get past this, like I've got this great chart that's just essentially illustrating where the IRRs are, where the break-evens are, and offshore, deep offshore, and shale are like neck and neck for all the returns apart from just payback period. And it just makes sense that once understand that just throwing money at shale, it's not gonna, it's actually going to be a lot more expensive moving forward once you finish off that one that's, yeah, you have to start forking out for these big long-term projects. It also ties in a bit with like the whole net zero. Like, why would you long cycle when we're going to be off oil? So I think you're seeing some of this play out, and if anyone's been paying attention to some of the, I think like BP was the funniest. Like they do it every few decades where they say they're getting off oil. I think it was back in the early 2000s. They were sort of beyond petroleum and had a whole lot of advertising and greenwash. And this time around, it was Looney who sort of said, yeah, we're it was Shell that said that, don't call me in, we're not an oil company anymore. But BP was the most notorious for like lighting money on fire, spending double what others were at wind options to hit their quota for like new wind farms and hydrogen projects. And yeah, as a result, they've lit a whole lot of capital on fire. And now I see the new CEO is just taking a 30% pay rise because he's dealing with all the fallout of it, and they're just pivoting really heavily back to oil. Yes, to answer your question, there's certainly some stuff that can move the needle, kind of some of the more shallow water, but yeah, the longer term, I think the break evens are, it's just a no-brainer to start allocating. They're going to start allocating money to that, and it's just such a small pool that can do that stuff as well. There's specialized assets, and as we talked about before, there's really been like sort of trimmed down. It's call it like kind of cyclicality at its finest. What happened there? A bankruptcy cycle where not only do you just, like I remember looking at back in 2020 how much more efficient these all got. They're just the break evens keep coming down, and with every asset that goes,
I've still got it loading in the other tab.
Clean out a whole lot of
it's like just saying 1 second in
these old contracts, get more efficient to survive, and then I some you've had go bankrupt twice. You've got like Seadrill test the internet's still running. It was like pulled up like a YouTube video instantly. That's going to set up for like the once Shale's off the table, those will make sense. Yeah, there's some other stuff that
should I close out this other tab that's open?
Can add around.
This tab is using your camera and microphone
edges, but I think it's offshore will definitely have to play a big part.
Yeah, certainly makes a lot of sense. And the uranium thesis is one we'll be waiting to. I mean, it is playing out, but not as quickly as some others would like. It's funny you mentioned tin. I see people on Twitter today talking about a Cigar Lake 2.0 moment.
Fucking scares me whenever anyone says that, because I knew you're about to get your ass handed to you. I think it was I forget which one, of the Ocean Wall, or they were saying like Cigar Lake moment was here a few months ago with uranium, and here we are. Painful, but the thesis is intact. It's just absolute pain on the equity side. Everyone's been horrendously wrong, myself included, on when the utilities were actually going to have to show up. They're still there in the wings. They have to buy, particularly in the US. Like, even if you go through, if you segment who's done the buying, like the key thesis was always that you've got kind of the utilities that have to come and they have to buy replacement rate, whether that's 185, 190 million pounds, they're going to have to contract that. There isn't enough to go around. If you sort of look out, like the deficits, it's getting bigger and bigger, but it's going to blow out to sort of, it's big enough already, but by 2030, you're already at sort of nearly a quarter mismatch. And that's sort of nothing when you consider they've got to get the uranium and put it through the fuel cycle. And they just haven't been showing up to contract in size. Like, if you look at 2023, it was 158 million pounds against 100 and as I said, 185 replacement rate. And then last year was only just over 100, not even just over sort of half of what they even need. And most of that was Chinese. It wasn't even the Western utilities. So I think it doesn't change the thesis, but it is definitely something I take into when I look at other commodities, is whenever you have someone that has a expert view on how much inventory is floating around out there, like, probably take that with a pinch of salt, because it can be a lot more floating around, and it can take a lot longer for a supply demand thesis to really gain traction. But with that said, it's going to matter at some point with spots run dry. Like, there's no real contracts, no real pounds that are running the fulfilling utilities needs, and it's this weird waiting game. And yet at the same time, you've got like the shorts, which is looking increasingly likely that they're just playing for the likes of Sprott Physical Uranium Trust to need to sell a few pounds to raise a few dollars. And if that's in a super liquid market, that could cause quite a panic across the space, which would just be,
I wanted to ask you about that. If they're trading at a discount to their NAV, is that part of the reason why the spot market has been kind of flat to down? Because the term market seems to be going ahead, staying through around the 80s. It's hard to really, unless you read what UEC put out, it's hard to really know exactly what they're being signed at. But does anyone have a definitive answer as to what the spot can do in the event? Can they sell these powers? Because I can't find a definitive answer on that.
Yes, so there's Triangle Investor Solution did a interview with John Cipriani. I've probably messed his name up, but yeah, he was saying it was seemed entirely possible that they could liquidate a few pounds, which I wasn't aware that they could do that to raise funds for overhead. And so yeah, not far from ideal, but far from a thesis breaker as well. Like it's just selling a few £100,000 to keep the lights on. It would just be more pain for the sector as well if spot trades somewhere silly for a short period. But ultimately, yeah, you're just back to what spots on a good year spot can make up to sort of 15, 20% of utilities contract. When it runs dry, it's just pretty much all term. And what we're seeing with term as well is just the lowest quoted price. That's not it. It's just weird how the whole market's just so opaque that no one can really know what's going on. And you, as Kapi often says, like most of the utilities is just like a WhatsApp group of people. It's not, there's no futures market to keep everyone honest. And I've found myself in a few of these markets now, like the likes of Rhodium, it's the same thing. It's just, you really are betting on the fundamentals, but the thing can trade wherever it wants to for periods. And if you're having miners been priced off that, you get no price discovery, which is just a nightmare if you are basing a lot off that, which I think a lot of people are. And so, yeah, it's going to be an interesting few months if it doesn't gain any traction. If the price gains some traction, some utilities come to the table, then you could see fireworks as well. Like I know some of them are getting up to like the likes of Boss, Paladin. That's like 3 weeks of volume to cover the positions they have. It's interesting, this kind of mismatch between the long-term fundamentals and what might happen in the next few months. Yeah, after the pain the sector's already been through, it's just crazy. Then it also kind of fits with the fact that this is so hyper-cyclical, it almost makes sense that it would wash out the very last retail investor before doing something crazy.
Yeah, that's the thing I've always had with uranium is that the thesis it makes sense from a macro point of view, but how am I actually going to make money on these things? Because I'm just loath to buy miners in the back of Africa somewhere. I don't know. How else can you play this thing? Have you looked, I'm sure you have looked at the bottlenecks around enrichment and some of the technology companies. Any of those take your fancy, or you're still just producers, developers, maybe an explore code for good measure?
So I owned Centris for a while, back into the 2019 to 2021, and then it just got crazy expensive and I thought it was ridiculous and sold it. And then it's got even crazier since. Like, I think I rode it from $3 to 20 something, and then it's since touched 100. So that's, I look at that and I'm like, well, should have just, a lot of the stuff, if you, you're prepared to, it comes back to what you're talking about, like position sizing can drive you nuts if it's all over it. If you're too large and it makes up, and it really runs, because it's not like owning coal where you just stare at your cash flow, or even tin at the moment, you just stare at the cash flow and it's quite comforting. This is an inherent bet on there is such a gap between supply and demand, and also demand's knowable. Like it's not like you're betting on how many sort of like, it's always been my problem with the likes of lithium, like you're betting on it being the ultimate winner in battery technology and X number of EVs out this year. With uranium, you just work it all out on X number of operating reactors, like 440, another 65 under construction. But yeah, as you say, you've got a position for the cash flow. Like I love Bannerman for that reason. Like they've got 2-step projects, and I think that they'll be eventually signing contracts, probably floors in the 100, maybe ceilings in the 150, 160. But that's a projection that has to kind of come to be in the future. There's when things get rough in the markets, no one really cares about your future projection. What's the cash flow of that asset right now? And so, I think there's no sector with better fundamentals and worse ways to play it than uranium. Yeah. And even everyone that was pitching the how much of a no-brainer the sort of physical was, well, yeah, not going to have any less volatility with physical now if they do have to sell a few pounds of liquid into the market and price spot somewhere silly.
And you mentioned Chinese tech. That's done actually quite well recently from what I've been looking at. I'm still the very proud owner of a few Gazprom shares. What's the likelihood one enters into the Chinese tech sphere and gets Gazpromed, as I'm calling it?
Yeah, so that was like the most common question that I had when I went into it was, what's the chance? I'm an American. What's the chance of me being kicked out of this and sort of liquidated out of this if we end up in some sort of a real something, things get serious with China essentially. The only way I kind of slightly prepare for that possibility is by owning the ETF listed in Hong Kong. So you could open, if you're an international citizen, you could open a brokerage in Hong Kong and have it transferred. So you could potentially get around it that way. I don't think it's last words, but I don't think that's where they're going to go. If you've been watching Trump, he knows with China, he hasn't gone nearly as hard on China as he has on some of the others with tariffs. And I definitely think with the Chinese, perhaps it is a risk if you're American. I still think it's very manageable. And when you actually dig into it, like a lot of the American companies they've stated they can't survive without their Chinese counterparts. Like if you want to see the craziest interview, look at some of the defense contractors when they're asked if they could disentangle from their Chinese suppliers. And Raytheon, which is I think the third or fourth biggest defense contractor for the US, said they can't. It's impossible. They're too intermingled with all their Chinese manufacturers. So yeah, I wouldn't have. It certainly impacts my sizing in that I wouldn't want to have it past something that I couldn't come back from. But at the same time, I think the risk's very minimal, and I think the upside's fantastic, and it's something that I want to position and to ride for a long time because it's an area I'm not an expert at all, but I just want to capture the winners. Like I just use the example of BYD, what's gone down in China with how they've sort of on the back of that property bust, they've decided we're just going to absolutely fund in industries that are deemed important. We're going to absolutely open the checkbook for them, support them, and we're going to then dial down subsidies, dial down state support for them, and we'll just have the most lean, efficient companies that can go out and take over corner all the developing market growth, which is where all the growth is, which is sort of a fascinating setup because a lot of the US companies, the likes I always pick on Tesla, but it's kind of priced as if it's going to capture all that growth, even though it's being chased down the Chinese market. And when you see people trying to value it, they're just getting increasingly desperate to say, oh, there'll be 90% margins selling robots in another 2 years or something. Like they're literally getting eaten alive in China. And you only have to look at what BYD's putting out. It's just the quality, the price. It's like they're like Apple releases back when a new iPhone was, every new iPhone was super, just always had a new innovation. It was fascinating. Like BYD, like why would you buy another car when you can buy one for 14,000 US with, that can do 2,100 charge and a tank of gas. I want to be long that, and I want to capture that. And I love the fact that it's completely uncorrelated to all my commodities and energy. The rest of my portfolio is essentially commodities. And I think also you've got such a tailwind with the CCP are behind it, and we'll keep propping it up, as well as the Chinese have sitting on record levels of cash. They're known for being big momentum traders, and with the property gains that have been over there, I can see sort of the stocks kind of investing in the local champions being really pushed, and that being a really big trend that you don't want to miss. And they're dirt cheap as well. It's not like you're jumping in there at crazy valuations. Like when I first wrote my piece, I was comparing some of them to coal stocks. Like some of them were like a third cash and trading like low single PEs. Like you're not taking that much risk.
Yeah, it would be a major cultural shift. Obviously, as Copy said, you find out what the Chinese want, buy it, and ride that that capex wave. How are you looking to capture that single stock picks, or are you taking a basket approach through, say, an ETF? Is there one that you like?
Yeah, basket with ETF. Do not back myself to pick any Chinese stocks. Like I was use the example of Alibaba. I thought it was quite dominant until I saw a chart, and there was like 3 other names that I hadn't even ever heard of that were eating its market share the last few years. And I was just like, Jesus, like I really, the amount of competition. It's kind of fascinating because I don't know if you've ever read the book, like The Myth of Capitalism, and it's essentially this book that goes through US, and it's just the consolidation of all these different sectors in the US and how they then they become oligopolies, duopolies, they have regulatory capture, and then once they've consolidated enough, then the company gets massive, and it's essentially crony capitalism. Like you're just killing competitiveness. We've got China, which we all hold up as sort of the bad communists, and they're actually practicing perfect capitalism in all these areas. And you're getting these perfect, what we would like, BYD is like the pinnacle of capitalism, if you will. I know people say it's obviously subsidized, and they gave them tons of state orders from government. Yeah, it's the way that they started with over 400 odd EV companies, and now they're down to sub 100. That's pretty pure capitalism. So what I was going through is you've only got a handful of options, which you've got like K-Web, which I wasn't as big a fan of because it'll do amazing, but I didn't want to limit just to sort of the internet sector. Then you can go up slightly bigger baskets every time. So you can go to Hong Kong Hang Seng Tech Index, and then you go up to UQ, which is a bigger basket again. That's like 160 companies, and then you can go up if you want to just capture the whole theme. You go up to FXI, which is pretty much Chinese large caps. It's kind of fascinating those as well, is because they're all shorted really heavily. FXI has like got I think it's 40 to 50% of its float short.
Yeah, large cap ETF.
Yeah, and at the same time, I've kind of observed like the other side of it. You got Tesla, which is getting eaten alive by some of these companies, and it's people have given up shorting it. It's gone from historically like 25% short float for a number of years to it's now 1.9% short when I last looked. And I think I don't know of a company that I think's in more trouble at the moment. Still was 100 times forward PE, but it's now probably like, with the recent fall, it's probably 90 or 80, I guess.
Well, that's very interesting. And you wrote in a recent Substack piece around some of the changes in the US, most likely leading to Chinese leaving capital. They're already kind of leaving the treasury market. And the question is, where is some of that capital outflow going to end up? One may well be in the Chinese stock market itself. And another likely beneficiary you mentioned is the shiny metal gold. Have you come around on the gold thesis? I haven't always been a fan of it as such, but now it starts to seem, to me at least, that you're entertaining the idea of entering into the gold sphere.
Yeah, no, I always liked the concept, but I just always wanted to separate paper from physical. And so I never liked the idea of betting on gold when there wasn't any price discovery. If you were going to be trading something like GLD, where there can just be issuance of a paper market. And so you're never going to have that. It was essentially a political metal, because I remember, I think it was Cole Bass or someone was like, it's you could tell it's a political metal because someone, if they wanted to, could just go to COMEX and have a whole lot of gold futures and just demand delivery. And you could have a run on the bank that way. And the fact that that doesn't happen just means, yeah, it's political metal. And whenever you manage the price by issuing paper, and that game was all fine. Well, it was in Western hands and under their control. But what we've seen lately, and it's really fascinating when you look at what the gold price has done and how it's been pretty much absent of any retail investment in the West anyway. Like you can see this if you look at GLD, you can see inflows. It's actually been negative. It was negative like 3-4 billion, despite gold going on the run it's been. So just the miners are all negative, highly negative. I think GDX is negative, 2-3 billion. And GDXJ, which is most interesting because it's actually got outflows have got like accelerated as the price has gone up, which is kind of doesn't really make sense at all. Like you'd think they would be more attractive as the commodity they're mining for is spiking. But yeah, what it's essentially telling you is it's all central banks and foreign buyers. I think Lewis Vincent Garve puts a good case forward that with the lack of trust in China for a long time, a lot of businesses, entrepreneurs, and just retail there were parking a lot of money in gold. Granted, the vast majority is obviously central banks have been buying it up. But yeah, even sort of foreign retail buyers were picking it up. And it's just, yeah, there's been almost no participation from sort of the Western investor or the Western speculator, which is, you can opine that maybe is because like a lot of the sort of more specky stuff has been replaced by crypto. But yeah, it's fascinating to see how hated gold miners are compared to what the commodity's done. That kind of fascinates me. And yeah, I run a whole lot of ratios and they're like beautiful charts. It's like I joked before, you want the charts that represent like a patient dying, like the sort of the heartbeat that goes lower and lower and that flat lines. And that's what gold juniors are.
Yeah, I mean, is it in a way kind of like a hedge against the oil sector as well? I mean, if the oil sector stays depressed and gold runs, these guys are going to do well on their margins? Or is it that same old problem with junior miners? No matter what commodity they're digging out of the ground, they're always junior miners.
Yeah. Probably more of the latter as well. If you look at like the all-in sustaining cost margins, like any increase in the miners, you generally lost it because their margins just exploded as their costs, exploded, not their margins. Their costs exploded, and yeah, you didn't get to take much home of the increase in the price. Just miners being miners. It's largely been my experience as well. We've all been in miners. Granted, there's times, yeah, if you get them really cheap, it's hugely profitable. But wish I'd cut some of them earlier than trying to carry them into production or anything like that. That's just proving getting put in a too hard basket a lot of the time now, as a lot of people found out with the likes of tin recently, like even if you have a fantastic project, the geopolitical risk can really whack you around the ears as well.
Yeah, TIA. And in gold, are we looking at, have you got names that you like, or are you looking to take a basket approach?
So yeah, I still haven't pulled the trigger on it. It will be more of a basket approach because I follow quite a few people that, and once you get in the more junior space, it just seems like a VC basket to me. They're just always having a few misses, and then they just point at their one winner that ends up a big multi-bagger. And I don't want that stress. I've got enough stress with having enough misses in the mining space and having bought enough stuff in Africa that keeps me up at night. That, yeah, I don't need to add. Pretty much my new rule. I'm trying my best not to add any more miners. I'm trying to add real businesses or even stuff that hedges miners. Like Rhodium. Like I make out like a bandit if the miner actually screws up, which is a nice probability. Yeah. You kind of get an inbuilt hedge, trying to be a bit smarter like that moving forward.
And I think I asked Rip Rule a couple of days ago what he thought the odds of a gold revaluation were, and he gave a 0% probability. He doesn't think that governments will move in any way that might restrict their fiscal profligacy. Do you see something like that on the horizon, though? Maybe a shadow revaluation or some kind of Bretton Woods 2.0?
Yeah, definitely possible with where they've kind of found themselves. Like they've made a lot of big promises with what like Doge is going to achieve, and no Bessett's kind of he said he wouldn't do it, but that's never proven anything with someone in government. They'll say it's off the table till they do it. But yeah, I don't know what form it would take. It's certainly interesting that the Chinese have been buying it up like crazy, and it makes sense that like what you mentioned before when I wrote the piece, that was with the recently released America First investment policy that they're looking to revoke a treaty which essentially allowed China to buy US assets with zero withholding tax. So if they remove that policy, then the withholding tax jumps up to 30%. And so that obviously scared the last of the treasuries, which not a lot of treasuries have already been like in massive decline since 2008, and really kind of accelerated with nail in the coffin was confiscating the Russian assets. But this is like, another sort of get the fuck out essentially was the title with, and I think, that's another 800 billion. But more importantly, it was like the US equities, like get out of our US equities, which is a decent amount. Again, it was like 760 billion. And the real question is like, if those are now off the table because they'll get 30% withholding, where's that money going to flow? And flown into gold, or can gold take those inflows? And if China's, I follow Luke Broman's work, and he's got a few different ways they can do it. If they just peg it to oil, then they could have a revaluation scenario, and it's almost in everyone's best interests in a way, because it doesn't actually blow anything up. If you increase substantially any other commodity, you're gonna hurt some part of the economy. Like if you severely increase the price of copper or anything like that, you'd damage economic growth. But gold, since it's not used for anything, it could help shore up balance sheets. Like with the US, it's all held on the Fed for, was it $30-$40 an ounce? And so that
42.16, I
42,
think.
I think that raises like, what is it, 700-800 billion? Yeah, but I'm probably outside my circle of confidence to say whether that'll happen or not. Just the fact that it's a probability probably means a possibility means that's a nice call option to have if you do own gold. And I certainly wish I had a bit more gold with what's happened, to use it as a sort of a rebalancing tool. It would have been nice to have sort of carried a bit of gold to use as almost like a sort of a 60-40 sort of rebalancing tool. If things just get silly, you can move it across. So that's kind of
and in meantime you're protecting yourself from that inflation or cash burn. Yeah, some of the things that you mentioned might lead to an argument of just simply why not buy the metal if you can, if it's good enough for central banks. Maybe that's good enough.
But that's Luke Broman. He's just a big camp of really short-term paper, gold, and Bitcoin. Then he said, sort of apportion them to your risk tolerance. If you're more risk adverse, more really short-term treasuries, more gold and less Bitcoin. And if you're wanting to stomach a bit of volatility, up the Bitcoin allocation, which is it's worked so far. Maybe worked a bit less recently, but yeah.
You come around to the Bitcoin camp, mate, or you're sticking with your Rhodium?
Sticking with the Rhodium, yeah. I like it when I can't even talk to someone about it, because there's no one else in the market that's even put an investment thesis out about it.
Well,
the what?
Yeah, mate. Rhodium, I wouldn't even know. There's no futures for it?
No futures. Yeah, I was quite sad because the one guy that was kind of an expert on it, he died last year. So I ended up talking to like Drop 3, saying like, could you give me Dr. David Davis's opinion on Rhodium here? Goes for all this work and has a conversation with me from this.
So now you are the expert.
Oh, I'm not the expert, God, no. Not on something so liquid, yeah. But I just like the asymmetry of it. Yeah, it's a byproduct, so it's really hard to increase supply. I think everyone sees it rolling over on the back of the supposed sort of EV boom, whereas coming back to BYD, they're absolutely dominating the Chinese and the world market. And if you look at their month-to-month production and sales figures, they're pretty much repivoting their production to plug-in hybrids. And once you have that, like going back 2 years, they were mostly BEVs, like straight battery electric vehicles with sort of less than a third plug-in hybrids, and now it's switched around. So now it's 2/3 plug-in hybrids, 1/3 battery electric, and that seems to be still dropping, or at least holding steady. And the key point there is that when you have a plug-in hybrid, you're swapping back and forth between a ICE engine and a battery. And so the initial start phase, when you have the most emission standards are getting stricter and stricter, and I just see a quite strong demand for PGMs, and in particular Rhodium, on the back of it that no one's projecting, because I think EVs are the future. And so what's
happened with platinum and palladium? It's shot up. Platinum and palladium have just kind of crawled along and got lower and lower and lower over the last few years. Like palladium's been completely smacked. Do they fit the same thesis? Because if so, how come we've got such a disconnect in the price?
Yeah, well, they're rhodium's literally a byproduct of them. So it's mostly a byproduct. Platinum is the most sort of the highest split. So over 80%, then nearly 85% of rhodium production is just in one little belt in the bottom of South Africa in the Bushveld, and actually in just a handful of deposits that get a rhodium split of 8-9%. Once you go outside that, the rhodium split in like nickel in Russia drops to like 2%. You go to the US, the palladium heavy, it's like 1%. And so that's another reason I'm a huge bull, is the fact I can see the sort of that particular rhodium-rich resource is being worked through and rolls off a cliff sort of 2030. Like so many commodities I look at, I'm like, I joke about a lot of them, like yeah, this is going to be important, but no one cares about it now. And some of rhodium, you've got this sort of this demand driver that no one really, because 85% of rhodium is catalytic converters. So it is slightly dangerous in that maybe it gets engineered out, but I'm guessing it's not when it's at a generally engineer stuff out when it gets too expensive, and now it's pretty cheap historically. But yeah, for your question of it being tied to platinum and palladium, it's obviously it's a byproduct, so it's completely tied, which is interesting as well, because with platinum and palladium being below their sort of cost curve for most producers, all the sort of, I guess, seeing mines shut in. Like Sibanye-Stillwater's been shutting mines in. Impala just talked about shutting a mine down early that was going to last another year or two. You had Nickel, which was going to supposed to be bringing on by 2027, additional 8% of global PGM production. Granted, that's very palladium heavy deposit, so it would have been low in rhodium anyway. That got postponed due to sanctions. In 2023 was when it was supposed to start and come online 27, and that's yet to they've yet to give a timeline to restart that. And that's like they're like the real Kazatomprom, if you will, because theirs is like a negative cash cost for their PGMs because it's a byproduct of nickel. And so when I go around the world and look at like the sort of the market makeup for PGMs, sort of the Russian addition isn't arriving. Yeah, they're going to bring on, but that's again palladium heavy, rhodium light. And South Africa is rolling over in an absolute basket case in almost every way, between the load shedding with power, between the governments just doing some silly stuff recently, and between the price obviously being in the doldrums as well. That's not incentivizing anything anyway. I love it.
Okay, so you're playing that by the physical. You still interested in Sibanye-Stillwater?
Yeah, I am, but I've made that far smaller position than it originally when I went in, just because I like the gold exposure, and then they sold most of it off. I also dislike that they have a few silly projects, sort of battery metals and lithium that make no sense. So yeah, it's a far smaller position. I like the optionality with it still on the sort of the platinum and the palladium, because maybe I'm wrong on rhodium. It's nice to sort of have call options on those as well. Overall, the one I'm also watching is Anglo-American platinum, because the parent's spinning that out. It'll be interesting to see where that trades in the coming months as well, because that's a lower cost producer and it's getting pretty cheap. But coming back to my rule, I'm trying not to own any more miners, especially in South Africa. And yeah, just African miners in general are a recipe for heartache. And so this disclaimer is go into it with your eyes open, because it can be a rough ride.
Yeah, indeed it can. Is there anything I've missed? Is there anything out there that you're looking at that we didn't cover today that you think is either still good value or could be into the future?
Tin's the obvious one. I've just been sort of implying with Alphaman just having the mines shut for safety, with the management deciding to do it for the safety of the staff, and who knows how long that'll be off. And so that's a pretty decent slab out of global supply. What's quite interesting with that is that was, if you look what happened in China, they were mainly importing from Myanmar, and they shut down they were their main supplier. With them shutting down, they've actually switched. A large amount was coming in from from DRC. And so now they've shut down as well. It does sort of beg the question just how tight this market's going to be moving forward. And
does that mean MLX can make some money now?
yes, hopefully. That's my big bet. Yeah, I'm reasonably weighty in that. And hopefully they can't fuck this up and pour it into specky gold juniors or something. Yeah.
You just had to say it.
Yeah, I know. We'll wake up tomorrow and we'll announce, some takeover for some moose pasture somewhere. But no, hopefully they can't screw this up.
The major shareholders that were selling a bunch of shares, have they left Metals X now? It's been a while since I've been on.
It's been pretty cleaned up. Yeah, I actually like what they've been doing recently between first tin, I guess it's a call option, at least it's in their wheelhouse of tin. It's not gold. And then building up the cash, not doing too much of buyback. It's kind of annoying, but now they're trying to hunt down get control of all the Renison. That's a worthwhile use of the money. Granted, that sort of low ball probably isn't going to look nearly as attractive with what's just played out in the market. The success of that's probably dropped off, but they've got a decent amount of cash to keep pursuing it. So if they could get that across the line, that would be massively accretive here, because they're pretty damn cheap, and now they're the only game in town. Really, you look around and there's really no other options. And I think even if Alphaman comes back on, a few people with PTSD, and that's going to trade a lot cheaper moving forward with that sort of history. And I think people are starting to get, you've only got to have a few sort of these outcomes between like Global Atomic, like everyone sort of but work out how good the deposit is, and sort of turn a blind eye to the geopolitical risk, and then just get absolutely cleaned up, and then realize, I'll take a little bit lower quality asset for a safer jurisdiction. Granted, I say this and I got my ass spanked in Queensland with coal, safe jurisdiction, and got robbed with a pen for egregious royalties.
I think that was pretty harsh. Easy to be blindsided by something like that. It's not something that you would normally expect, but these things happen. Thank you very much, mate. Great chatting with you as always. Guys, if you're interested in learning more about trader Ferg, Substack link will be in the description. Any wise words you want to leave us with, my friend?
Not really. Just, I think I put a quote in my recent piece that was like, value investing's pain, and the higher the level of pain, the better the future performance. So just know that, when I look back at all my biggest winners, I was like literally tearing my hair out when I was seeing the buy orders hit, and I just wanted to go open my brokerage up and go in and sell immediately. I was like, no, this is just ridiculous. How can there be trading there? I'm missing something. And so, just know if it feels really good when you buy it, you're probably doing something wrong. And if you kind of feel sick in your stomach and you hate even seeing it, then that's often what's required from real outperformers, real multi-baggers.
Value investing is indeed an acquired taste. Guys, thank you very much for tuning in, and I look forward to catching up with you in another episode of the ROI podcast. Take care.